what I want to indeed try to do is be a little bit thought-provoking at the beginning, then also to some degree express dissatisfaction with some actual movements in the industry, and not be too technical, but give a few ideas on what might be a possibility to overcome some of these difficulties or strange uses of instruments which have been clearly intended for some other purposes as they are used today. To start with, and that is more or less the INSEAD philosophy, claiming to be the global university for Islamic finance. First of all, they claim that Islamic finance is not only for the Muslims but for the world at large. If so, then of course Islamic finance has to help to solve the problems of the world at large, but it also should be able to promote developments in the world at large. And there are some developments and some changes taking place in the advanced economies, let's call them this way. Previously they were called industrialized economies, and in the emerging markets. And one of my questions is, will Islamic finance be able to push ahead with those very important new developments? Are there adequate instruments available? The answer will be in principle yes, but the way they are used now probably leads the whole development in the wrong direction. So here are some of the claims that you usually can find. Islamic finance claims to finance the real economy, support economic development, is a better alternative not only for Muslims, and is based on the concept of risk sharing. At least that is pronounced over and over again in keynote speeches and addresses of anniversaries and big events. But it's not so clear how much risk sharing there is on the ground. Actually, yes, I'm coming from Jeddah. I attended a conference on Islamic economics. After 30 years, what has been achieved? And the result was not much, because the practice has diverged tremendously from the models that have been developed 30 years ago, and risk sharing was one of the key alternatives. And if I imagine an economy based on risk sharing, based on equity finance to a very large degree, clearly the world would look different from what it looks now. But I don't want to blame anybody about this, but if so, if these claims are taken seriously, then Islamic finance should be able to finance, as I said, the advanced economies, and it should be able to support the catching up of emerging markets. But then Islamic finance requires instruments for the financing of what I would call the knowledge-driven economies. I think increasingly our growth, although meager right now, but increasingly it is a knowledge-driven thing. It is a special sector of the service, in the service sector of the economy. Just the example of Germany, because the latest figures were easily available to me. It is no longer an industrial country or industrialized country. Manufacturing and construction are only 30% of our gross national value added. 64% are financial services, excluding financial services, and if you include it, you have much more than 2/3. In the UK, I assume that financial services are much more important, but I think the German figures are still impressive enough to say that we have a service-oriented economy. And what is driving this is not McDonald's. Usually the argument is that are very simple services, poorly paid jobs, etc. No, what is driving and contributing to the growth of the gross net value added are these knowledge-driven services. From engineering to research, from healthcare, for example, to education. So I think the long-term growth drivers for advanced and also catching up economies are intelligent knowledge-based products. And these products have some qualities which are worrisome, or at least they would be worrisome if I'm a Sharia scholar and I'm following the old paradigms. What can I do with these products? They are intangible. Okay, that is maybe not the worst problem. That means we are talking mainly about intellectual property rights, or to a large degree about intellectual property rights. But I would say their existence sometimes is not so clear. In a sense, they are blurry. For example, patents. Patents for what? For example, patents for genetic resources and patents for knowledge of indigenous people. Very important for medical and pharmaceutical research and the industry. But they do exist, the genetic resources do exist, and the knowledge does exist, but is it an asset? It only becomes an asset when it is recognized by the legal system, but not all legal systems recognize this. In some countries it's highly disputed. We have the WTO, there are protocols about intellectual property rights, including these assets, but it's not so clear from a Sharia point of view, is this an asset where you can use asset-backed or asset-based securities or other forms of finance? Even if you accept that this in principle is an asset, you have huge problems to find an adequate price for these assets. We have some other things like computer software, where we have a kind of the winner takes all or takes most of it, a competition, because if you are the first successful provider, let's say, of a new operating system, there are lock-in effects. Many people are still using Windows XP because the learning costs are so expensive that they don't change it. Once you have established your quasi-standard, then people are locked in, and that means even if, let's say, other systems are better, are superior, it will not change. My very simple example is whenever I travel here, I have to look that I get the right plug for my computer, because you are locked in. We could not agree on the same type of power outlets so that we can use it universally. Fortunately, knowledge-driven, there are now these outlets where you can plug in whatever strange cord you have. But these network externalities means that somehow systematically, if you are, for example, financing Microsoft or you're buying shares of Microsoft, you hope that they will become the monopolists, because then you have huge profits. If you are buying shares of Apple, you're hoping for the same. And if you go for Unix or something else, again. But we know that only one can take it all. That means there is a systematic overpricing in these markets. There are inherent bubbles, not only in these markets, but this is a nice example also to some degree in real estate, but this is a different type of argument behind it. Now the disputed legal qualities, I just mentioned this with the question, is it in existence at all? And is it possible to trade these assets, if they are assets? Because sometimes I was quite astonished to see that you can use airtime for a mobile phone company as the asset for a securitization. You cannot sell airtime as such. It is, in a sense, it is a monopoly that is created by granting a license to a certain company, and the government is preventing others from doing the same business. But it is a very artificial thing. And how much airtime is used and how it is priced and what people are willing to pay for it, we don't know. So it is highly speculative to put a numerical or monetary value to this. And you need transmitters, and you need a whole range of support infrastructure, otherwise this will not work. So can you isolate this from the rest, or do you have to take it as a bundle? I'm not quite sure. So in that sense, there are some things which are important for economic development. However, it's not so clear whether they are classical assets, and if they are assets, how they could be priced without much speculation. So what can we do? There are some challenges. As I said, key assets are intellectual property rights. Are these products suitable candidates for traditional forms of Sharia-compliant asset-backed and asset-based financing? Or more general, how suitable or adaptable are Islamic finance products and techniques to the requirements of knowledge-driven, advanced or emerging economies? It's easy to finance bricks and mortars, and there is a strong preference for this, but this will not drive the economy forward. You have to have someone who is sitting in these buildings and who is creating new ideas and new products and new technologies. And here I just summarized the issues which I just mentioned: blurred character, privatization, commercialization, as a result of the restriction of formerly free access to natural resources. Take this example of genetic resources. You find genetic resources and you find indigenous people who have knowledge about the medical qualities of these resources. You can create a patent only by restricting the use of everybody of what was initially a free public good. Are there Sharia issues involved? Probably yes, but I'm just asking here. Then, for example, my airtime example, what about delivery of these assets? I mean, we accept that you can securitize or that airtime is an asset, but when will it be delivered? The minutes of airtime are delivered only when they are used up, and that may take 1 year, 2 years, 3 years, depending on how the market is reacting or what you are trying to sell to the market. And will this asset, as it has been valued, ever come into existence at all? It's also questionable. So price bubbles, speculative price distortions, winner takes it all competition. These are some of the issues that could be or should be addressed. Now, if we look at the arsenal of Islamic finance, what do they have in order to finance activities in these markets? Well, in retail and universal banking, we have mainly short-term instruments of dealing with traditional assets. Medium to long-term financing is mostly confined to home financing, so we can ignore that. Investment banks are strong in bricks and mortar and government-backed project financing, as well as in commodity trading. And we only have seen very few, if any, real venture capital initiatives, mainly or probably due to the fact that there is a strong risk aversion, at least in markets beyond the real estate market, by the way, for good reasons. And on Sukuk and how participatory forms of Sukuk are applied, I will talk a little bit later on the next slide. If you look at capital markets to finance these activities, I mean, the conclusion is that for the time being, banks are probably not in the good position to finance these important blurry assets. Now, what about the capital market? Is there a better possibility? Yeah, stock markets, it might be a possibility, but I think so far there are limited potentials, in particular because before you can go to the stock market, you have to develop something. So there is not necessarily just establishing a new company, but there is a growth period that has to be financed, and only then probably stock markets are the right strategy. So I'm left with Sukuk. Out of many conceivable types of Sukuk, all types which require well-defined tangible or even intangible assets, and existing specific assets that you could lease, sell, etc., are not suitable, because I'm talking about assets that do not yet exist and that cannot so easily be sold, etc. So that means 90% or 99% of the Sukuk market, or 90% of the Sukuk market from today's perspective, does not use the instruments that are suitable. What is left are Mudaraba and Musharakah Sukuk, because they are participatory forms of finance, and we should take a closer look at these instruments. They are presented as equity-based instruments. They are very flexible. If you look at the AUFI standards, for example, there are two standards relevant here. Sharia standard number 17 and later on Sharia standard number 12. And I have quotations from that. The point is, if we do not yet have the assets, but if we want to create these assets, we actually need a kind of a corporate finance, not an asset-based or asset-backed finance. We need corporate finance, and this type of participatory Sukuk might be a very good approach if applied properly. Now, yeah, I think we can go to the next slide. I mentioned all of these points. Just let's take a look at AOFI's standard. What is a Sukuk, an investment Sukuk? It is a certificate of equal value, you know this, representing undivided shares in ownership of tangible assets, usufructs and services. Rights are not mentioned here, but maybe rights are part of services, I don't know. Or in the ownership of the assets of particular projects or special investment activities, and that's what I'm talking about. I'm talking about setting up some project company, not from scratch, but there is one partner who has experiences in it, for example, a pharmaceutical company who wants to explore more the genetic resources of the rainforests. So they have assets, they have knowledge, they have experience. They could set up what is called here a special investment activity, and others could participate in it. They could contribute money, and then you start creating these assets. However, this is true after receipt of the value of the Sukuk, the closing of subscription, and the employment of funds received for the purpose for which the Sukuk were issued. Yes, so what is in blue is more or less supporting my idea. What is in red might be an obstacle, and I will mention a few of these things a little bit later. Now, more specifically, Musharakah certificates are defined as certificates with the aim of using the mobilized funds for establishing a new project, developing an existing project, or financing a business activity on the basis of any partnership contracts, so that the certificate holders become the owners of the project or the asset or activity as per their respective shares. That means actually they are not becoming owners of an activity, that is probably not possible, but they are becoming owners of the corporation that is involved in this activity. So Musharakah certificates would be the instrument that I would favor. There is a lot of options in the AOFI standards how to design such a structure, such a Sukuk. A structure for the purpose of corporate or project financing could be such that the focus shifts from the underlying asset to the underlying business or business strategy. I think that's very important. And the entrepreneur, usually the obligor in the conventional Sukuk, and the financiers, that means the Sukuk holders, share returns and risks in such a venture, which is often proclaimed as the essence of or distinctive feature of Islamic finance. And innovative startups, as well as growth of established companies, I should add that in that slide. No, it is there, as well as the expansion of successful corporations could be financed. However, we have a lot of Musharakah Sukuks. We had even very many Musharakah Sukuks, and then we had this verdict of Taqi Usmani. So what went wrong? The practice did not use this flexibility in some respects, or overused it in some other respects. Actually, the flexibility was used to reconfigure this participatory instrument to create another fixed income instrument. So the risk-sharing elements were taken out, partially due to the repurchase agreements which have been criticized, and they have been revised a little bit, but partially also and mainly because of the, I would say, skimming of all profits beyond LIBOR, maybe LIBOR plus, related, LIBOR-related level of returns for the Sukuk holders through incentive fees given to the manager or obligor. The point is that you agree on profit sharing, but there is a benchmark, and the benchmark usually was LIBOR, and whatever you earned in this partnership, legally or formally partnership venture, was given to the obligor, to one party only, as an incentive fee for good management. They have above benchmark returns, so that was good management, it was given to them. It looks strange, but unfortunately it is perfectly permissible according to AOFI standards. So it was not permissible to use this repurchase guarantees with at face value, but this skimming of profits was permissible and still is permissible. So just on here, two quotations with regards to the profit sharing. Where the first one is very general, the owners of these certificates share the return as stated in the prospectus. And the second one is just repeating this. Can we just go to the next slide? Now, this refers to Musharakah, that is Houfi standard number 12, Sharia standard number 12, and there you find the Sharika contract, that means also the Musharakah contract, should incorporate a provision specifying the manner of sharing profits between the parties. And please note it's not specified any further, so that gives a great flexibility. The allocation of profits must be made in a manner that gives each partner an undivided percentage of profit, not a sum of money or a percentage of capital. But the most important thing is the next quotation. Still on that slide. The parties may bilaterally agree to amend the percentage of profit sharing on the date of distribution. Frankly speaking, I don't know what that means. The day of distribution is the day when I know what I have earned in absolute terms. If I'm allowed to change on the same day, well, then forget about the whole structure. So probably it means after you had agreed on a percentage, and then the day of distribution comes, and then you realize that one party gets too much or too less, then for the next period you can modify it. But this here is quite unclear what it actually means. Also, a partner may relinquish on the date of distribution a part of the profit that is due to him in favor of another party. That is the basis for the incentive fee. But actually that happens on the same day, so therefore I'm a little bit confused. What does the first sentence mean in that context? And this has happened. All the probably I don't know all Musharakah Sukuk, but all that I have seen have exactly such a clause. And therefore they have become fixed income instruments, and therefore they are not used in practice for what I think they should be used. And therefore the question is, what could be done to bring it back on track, because there are jobs that have to be done, and that is the only instrument that we have that could be employed. If we just continue with this quotation, it's important that the partners can agree on the adoption of any method of allocation of profit, either permanent or variable, for example, by agreeing on the percentages and so on and so on. And again, the last one is another quotation where you have this ceiling and this incentive fee, which is legitimized. Now, here it is just to remind you what are the critical parts. If it is permissible to agree on any method of allocation of profit, either permanent or variable, that allows, maybe with some time lag, maybe even without a time lag, to track any benchmark, for example LIBOR, if you like. And the second is that profit in excess of LIBOR plus goes to the Sukuk manager, usually the obligor, as an incentive fee. So here you have my problems just highlighted. There is, by the way, a very weak argument why it must be a percentage. I'm wondering if it is so flexible, why do you insist on giving a percentage and not a fixed amount? Because actually you are structuring in a complicated way just in order to provide more or less the same result. The basis for the Sharia ruling is that you must not exclude one partner completely from receiving a share of the profit. But there are other methods. It does not require fixing a profit sharing ratio. That could be done in a different way. So that's what I found, and that is what in the Houfi standards as the basis for Sharia ruling I find particularly weak. But what might be a possibility? What could be done? Just the third bullet point here. Quite recently, three colleagues from INSIEF and ISRA, with whom I never spoke before, I just read it in their journal, came up with an idea of an automatic variation of the profit sharing ratio in reverse proportion to the absolute amount of profit that has been generated. They assume a certain benchmark, and they are talking about the average performance or return in an industry, in a specific industry, and then they propose if the actual returns that have been generated are above, automatically, according to a formula that has been agreed upon, the profit sharing ratio, for example, for the Sukuk holders goes down. That means if there is a return above the benchmark and the sharing ratio goes down, more goes as a kind of an implied incentive fee to the obligor, to the manager, and vice versa. So the formula is a bit complicated, and I have a slightly different proposal here, and now it becomes a little bit more technical, but I try to give you a numerical example what might be a possibility, which could not only be tried with respect to my blurry assets. You will not start with the most difficult part right from the beginning. So you could try to implement something to get more experiences with such an instrument, and then maybe you have something that could be viable to solve my problems of my knowledge-based economy. So the ingredients for my model are quite simple. An obligor provides equity for the establishment of a project company. I especially call it not SPV, it is a project company. They want to go into the rainforest and develop genetic resources. Let's take this as an example. The project company issues a Musharakah Sukuk to expand the startup capital, which does not mean startup from scratch, but the company is well established, but this project company is just a new department with a separate legal entity, legal personality. The business of the project company is expanded, and this expansion is financed by Sharia-compliant debt instruments. You can purchase additional assets, so that is all asset-backed. You can use murabaha or whatever. So the total balance sheet then will, on the liability side, consist of these taken on debt, on the sukuk, and on equity. And profit sharing is relevant for the non-debt capital, that means for sukuk and equity portion. Now, the abbreviations in a successful company, the total return on capital, ROC dollar, that means the amount, exceeds the costs of debt financing, that means the return on debt. Otherwise, you better close down this company. So if that is the case, you have a very nice built-in effect, namely a leverage effect, which you don't have if you just look at profit-sharing ratios and confine yourself just to the sukuk. If you make it a project company, then you have this possibility, which probably could create beneficial incentives for all parties. Now, number 8 is in the incentive fee model, sukuk capital is factually treated like debt capital, because you get the benchmark, or let's take LIBOR as the benchmark, or maybe LIBOR plus something, because you are in a very dynamic industry, but at least there is a fixed return for debt capital for that industry. And if you use the commonly used incentive fee model, then the return for the sukuk holders is the same as it is for the debt holders. So that would not be very appealing. I would not go for a sukuk unless I'm in dire need of some returns for my portfolio, because I'm an institutional investor and nothing is available. But that is a very, very weak argument if you want to convince the world that there is something in it, not only for those who are Muslim investors that have this restriction, because there are not enough profitable assets around. You must provide some other incentives. So the traditional incentive fee model definitely does not make it interesting for conventional investors. The leverage benefit that is there is fully absorbed by the equity capital. That means in addition to the incentive, you get all the leverage in addition to it. So that makes it very attractive. would make it very attractive for the issuer, for the obligor. Now, risk-conscious investors, Sukuk holders, would require more than LIBOR plus. Now, in the next slide, I tried the a little bit very simplistic formula. I can do it more complicated, but I promise not to be too complicated. Now, the profit-sharing ratio for Sukuk holders, that means P percent of the generated profit goes to the Sukuk holders. Now, can be calculated in such a way that Sukuk holders participate in the leverage benefits, and that, I think, makes it more attractive. This implies that the rate of return on Sukuk, ROS now in percent, the relative rate, and the rate of return on equity will exceed the rate on return of debt, but the rate of return on equity, of course, will be less than in the extreme incentive fee model, but still it will be higher than without this component. The formula could be very simple as follows. As long as the debt receives more than you are generating, you are making losses, and there is no discussion about it, as these losses have to be shared according to the capital shares. But then for different scenarios, for example, you could say that if the return on capital is equal or larger than the return on debt, that means the return on debt capital, Sukuk, and equity, so the return on total capital is larger than debt, LIBOR, then P should be calculated such that there is an equivalent between return on Sukuk, the return in percentage for the Sukuk holders, and the return for debt holders. That is what is practiced, probably not very attractive. However, you could change the formula. You could say that, no, I take C, the return for Sukuk holders should be the same as the return for equity holders. So then they are sharing likewise. Or, for example, something in between, the return for Sukuk holders could be equal to the return on the total capital, and that is in between the extremes. And on the next slide, it's a very simple numerical model to illustrate what I mean. If you start with the we cannot go through all this. Maybe just I pick up this one here. Here are the formulas that I propose. They are alternative, not all at the same time. You can choose. Let's say you choose this formula, that the return for the Sukuk holders should be equal to the return on equity holders. We know there is this benchmark rate, that is the debt capital, the return on debt capital. Let's say it is 10%. We know the total capital, it's just an assumption, just a numerical game. Total capital is 200, composed of 100 debt, 60 Sukuk, and 40 equity. And we have this market rate for debt capital of 10%. Then it's relatively easy here to calculate who gets what. The debt holders always get 10. And assuming here, for example, that the X means return either on capital, if it is 20 in total or 10% as a percentage, then it is equal to the debt capital, and that means if you want to treat everybody equal, that means also the return for shareholder, for Sukuk holders and for equity is 10%. If you are performing better, so the total return on capital would be 30, for example, it means again 10 for the debt holders, but then 20 extra have to be or can be distributed between equity and Sukuk holders. Since we assume it should be the same, it is again 20%, simply by allocating, very simple, the 30 in proportion, in such a proportion that you get an equal return. Or here, this one is where the return for Sukuk holders is like the total return for capital. That means it must be adjusted such that Sukuk holders get 15%. And if that is a set assumption, that means by implication, what remains to the equity holder gives a return on equity of 28%. So if you compare here, the winner takes it all version is 35% for equity holders, and then it comes down 10%, 20%, 28%, 25%. For example, we share 50-50. We assume a sharing ratio of 50%. The difference between the traditional models is that I still have debt capital here, and therefore this leverage effect, and that makes the difference. So that you get for example, 17% return for the Sukuk holder, which is clearly better than the 10% as if they were treated as debt, and 25%, so significantly more for the equity holders. Now you can formalize the whole thing. I don't want to go into any formalization, just this numerical illustration to show you that depending on what formula for the distribution you choose, you get different internal rates of return for the different types of capital providers. And the good thing is that I didn't find anything in the Sharia standards, as I quoted them, that would prevent me to propose such a formula. There is nothing, first of all, disallowing taking on additional debt in a project company that has been financed by the issuing of Sukuk. So once you are not financing an asset but a company, this company can also go to the capital market or to a bank to acquire additional assets they need on a debt-based Murabaha or Tawarruk or whatever you have. And then I think the use of such a formula for the distribution of surpluses is fully in compliance with what AOFI allows. It includes as the extremes the actual practice and shows clearly the disadvantages of the actual practice. It shows the implications of the more simple model that we just fix the sharing ratio and then we keep it as such and anything in between. I think it is probably better than manually fine-tuning the profit sharing ratio every time you know what you have achieved. That really is, I don't know how to... Okay, you said it. So I think it is possible without much stretching or much financial engineering to come up with a use of Musharakah Sukuk. Mudaraba Sukuk would be the same thing, slightly different model, which comes much closer to the original intention of risk sharing, profit and risk sharing, and it helps to create some vehicle for financing my blurry knowledge-driven assets at the beginning. So the next slide is just again a summary of what I've tried to explain with the numerical examples. So the model illustrates the effects of a rather small set of parameters which have to be agreed upon. It's not that you need hundreds of pages of complicated legal text. You just have to decide either you go for total capital, return of total capital equal, let's say the shareholders get the same as the Sukuk holders get the same percentage as total return on capital. So that is quite simple to agree upon. These are the parameters, and if you set this, then it's simple to calculate what that means for the profit sharing ratio. If I say the internal rate of return should be this and that, then this simple arithmetics generates the adequate profit sharing ratio that you have to agree upon, but you could keep it during the lifetime of this contract. So factually, the obligor would decide on the formula and the parameter setting and the communication of these parameters would be done in the prospectus. And if people find it attractive, because now they are really sharing risk, but they are also sharing reward. Not everything that is above the average goes to the obligor. They will buy it or they will not buy it. So I think that can be quite a transparent thing, and basically that's it. The idea was really to come up or to revitalize with some very simple modifications an instrument that you urgently need for other purposes as conventional brick and mortar financing. But if the practice continues, if after 10 years we have nothing else than what we see now, it is Sharia compliant, and then you have a lock-in or a lock-in effect, and you will hardly come up with something else, or you create complex, much more complex new instruments. So it could be done in a very simple way. That's the message, quite modest.